Good morning, everyone. It's Jared here again from the Alpha Capital Group, giving us a weekly round off for the week of volatility that has just ensued. I suppose first things first, when we look at the big elephant in the room, which was the CPI inflation print yesterday from the US, we saw that the levels or the calculations came in pretty much as expected across the board in the CPI figures yesterday, which led to the market's actually holding off some of those lows off what was a very, very volatile start to the week. We did say on Monday that the CPI print, if it had to go higher, would have put a lot of extra stress and pressure on the stock markets, on the equity markets, and of course on the indices also. However, largely speaking, the figures did come in on consensus. We saw 7.9%. We didn't quite break the 8% handle on the inflation print, even though 7.9% is massively inflated at the moment. We were seeing that the price came in on expectation. So as a result, I think a lot of the earlier selling in the week in the expectation that the inflation figures were going to be higher was actually undone yesterday, causing a simple sell the rumor by the fact scenario where the indices actually rallied through the course of yesterday's session. And also this morning, we are seeing the indices kind of marginally up. As a direct consequence, we're seeing the oil prices pare back a lot of those gains from where we were at the beginning of the week, which we'll look at very, very shortly. And we're also seeing a lot of volatility in gold. Gold had initially created lows around 1970, 1980 level earlier this week. We did temporarily break back above the 2000 print yesterday, but obviously on the positive news, on the positive sentiment, the price action has moved lower as risk assets have taken control into the weekly close today. So I suppose I know there's a lot of time left for the weekly candle closures, but I suppose the impetus now trying to chase positions on a Friday morning, Friday afternoon, is probably going to be detrimental for a lot of people's accounts, purely by the fact that the indices are at this moment in time currently moving higher. So I suppose a recommendation would be to, I suppose, assess the price action, because we will look at some of these weekly candles as well on the indices, assess the price action, allow those candles to close. So at least that would then you have a bearing and an understanding, I suppose, of where we're heading into next week. Now, of course, Monday we will be doing another preview. But until then, let's just have a quick look at some of these charts. So first things first, we can see that the S&Ps held those 4150 lows from, I suppose, Monday and Tuesday. The price action did rally back Wednesday with some consolidation, as we said yesterday, pre-market ahead of the buying. So I suppose if we looked at the 1 hour, the 4 hour, we are seeing the S&Ps marginally up from those lows earlier in the week, and the price action is holding under this critical area around 4280 to 4300. So I suppose my intention now today is to see, does the S&Ps close back above this noted level around about 4280 to 4300. Okay, if that is the case, then the bulls are definitely back in control into the early parts of next week. Now, of course, the caveat in the room, or the caveat to this, is that we do have to be conscious of any developments regarding Russia-Ukraine, because of course, in the blink of an eye, our fundamental view can change very, very quickly, despite what the price action is telling us. So just be conscious of that as well. If we move across to the Nasdaq, we're seeing a very, very similar thing. We had broken through those 14,000 lows, as we alluded to last week, and obviously on Monday the price action had come down. We didn't quite come down to this 1300 level to try and take out this wick from the previous week. The price action did see a lot of momentum kind of Wednesday into Thursday, and the price action is trying to close above this 13,500 area here on the daily. Now, I suppose, again, just to kind of reiterate that view, we are seeing a lot of downside weekly wicks. We saw a wick 2 weeks ago. Price action this week has tried to engulf this wick, but has obviously bounced back. Even here again, if we look at the medium term bullish outlook from last year, we did see some wicks again. So there's a lot of there's a lot of volatility, kind of choppy price action between the 13,000 and 13,500 level. Okay, very, very quickly, if I just round off the weekly on the S&Ps as well, we can see here very, very quickly that the S&Ps is also creating a lot of weekly wicks as well. Okay, particularly if we just kind of emphasize the price action, we can see here that there's a lot of wicks. Even on the upside, when the trend was moving higher on the higher highs, higher lows, there was a lot of wick action, but more evenly on the downside. We had a wick here. The price action even has yet to engulf the previous wick from the end of January. We're still kind of trading within this range between kind of 4150, 4300 now after the break initially on the daily kind of the beginning of this week. So I suppose the intention is that if the indices were to sell off, we would be looking at these levels to be taken out, to be engulfed. But as we see at the moment, the price action does seem to be holding relatively firmly above this 4150. So although the Nasdaq is getting hit quite heavily, the S&Ps is holding up fairly well in comparison in terms of percentage terms. So I suppose interesting, keep an eye on that. Last but not least, then in the US is the Wall Street Dow Jones. Okay, so the Wall Street Dow Jones kind of reiterating some of these levels that we looked at in previous weeks. I suppose all eyes was this week on this 33,000, 33,200 level. This was the area consolidation which held right through from last March, which is again a yearly range. So if you looked at the price action over the last year prior to this week, you would arguably say that the price action has remained between 33,000, 33,200 lows and our highs up here 37,000, keeping a modest 3,800 to 4,000 point range. Now, obviously, of course, at the beginning of the week, we did see that sell off. Again, I think was in the expectation of that the CPIs this week was going to be bearish. Now, we didn't quite see that momentum take hold. Now, at the moment, the Dow Jones is holding around this yellow level. So, of course, if you're looking for a bearish weekly close on the Dow Jones, we would be looking for this 33,000 handle to be broken and for the price action to close below this level on the weekly. Now, of course, to round that out, if we look at the weekly, we can also see the weekly rejections at this level. So 33,200, 33,000. The price action is refusing to close underneath this level on the weekly. So please bear that in mind if you're trading the higher time frames. I suppose, as we said there, the 4 hour, we saw that little bit of optimism, the double bottom structure, the price action rallied back, refused to break out these lows from the 23rd of February. And the price action is hovering now between, kind of, as we said, 33,000 and 33,200. And I suppose all eyes, if we're closing bullish today, we could potentially see the Dow Jones continue to rally back to this 34,000 level because we saw that before. However, if the price action fails to kind of close strongly this evening, well, then is that giving us the viewpoint that next week could see a little bit more blood in the waters in terms of downside progressions? Let's just wait and see, because these things are changing very, very quickly. Okay. And last two, I suppose, just to round off the week, if we look at gold, we did see that massive move into this weekly level here. So this was the weekly wick or weekly candle closure from way back last year. Price action refused to close it. We did temporarily break above it on the lower time frames. We have unwound that position, and we are now trading in this consolidation between, as we said yesterday, kind of 1970 and this area around 2000. We did temporarily break through 2000 yesterday, but with the indices kind of rallying back a little bit, there was a little bit more of a risk narrative associated to this position, which meant that gold kind of unwound some of that bullish momentum yesterday. Of course, if we look at the 1 hour, just to kind of, for those who are intraday traders, we had that daily wick or hourly wick rejection, as we alluded to before. Price action now is in a state of consolidation. So if we're looking for the price action to continue moving higher, we would in theory probably be looking for a daily closure back above the 2000 level here, and looking for the price action to then continue propelling higher to test those areas that we've obviously looked at. On the higher time frames, I do think that if this commodity super cycle continues to ravage on, then the idea that, yes, we're creating a large weekly wick up here, but that's given us the potential for in a few weeks' time that if the fundamentals continue to be bearish, that the price action will in effect try and engulf this wick and continue propelling higher, which would set forth a kind of a medium to longer term price point of gold moving into that $2,250 mark over the next maybe 12 to 15 months, or even probably less, given how volatile it has been over the last 6 weeks or so. So that is gold. And to finish off, we have seen a lot of volatility also in the commodity sector, with oil as well getting hit. So this is where we opened up at the beginning of the week. We did gap higher into this 127 level here in the dollar per barrel. We did temporarily even break through, but we did see that very, very clear unwind. Price action was in this bullish structure. The 50 EMA, this area around 122 to 120 was broken, and we saw a massive decline very, very quickly back to this 105, 110 range. Now, yesterday, we did see a little bit of a spike with gold rallying above that 2000 level, but the indices rallying, the kind of the risk on narrative that was kind of portrayed in the markets over the last kind of 24 hours or so has meant that oil has ticked slightly lower. Now, I suppose there's one thing I want to mention is that this gap from the 25th of February has still yet to close, illustrating that can the price action potentially pull back into this level at this point in time. I would not rule that out, even though everything is bullish with Russia, Ukraine at the minute, and oil is obviously rallied through the roof. And there's nothing stopping the price action to potentially pull back and close this gap, particularly if there was a positive narrative spun in the media. Okay, just keep an eye on that. Also, as well, again, the short-term volatility. This is something I also noted yesterday very, very quickly on the oil prices. Just let me show you the chart. If we look at this 1 minute candle here, we can also see yesterday, or not yesterday, but on the 9th of March, we had this massive gap as well. So this is again alluding to the volatility that we're seeing, not just in the oil markets, not just in gold, but across the current asset classes at the moment. Oil was very, very quickly moving lower. All of a sudden, we got a pop higher on a piece of fundamentals. Okay, then there was a news narrative broke regarding Russia, Ukraine. Price action gapped higher very, very quickly. So these are always going to be the fears in the markets. Now, if something bad happens, you could potentially see these gaps play out. Now, of course, this 104 gapped all the way back into 109, and then the price action went sideways. However, if we just go back up to the lower time frames since then, we can see that the price action has closed the majority of this gap pretty much back down here. So of course a breakthrough 104 would actually close the rest of that, and the price action would allow for more downside bearish price action. So of course at the moment into the weekend, oil seems to be trading lower, gold seems to be trading a little bit lower, the indices seem to be marginally higher into the close. But of course, let's just wait and see. Now, I suppose, again, one final 11 here on oil is this area around 104. We can see that consolidation level here, rejection. We've broken through and we're currently retesting now. So I suppose this area kind of around 107 to 108. If the price action doesn't close back above this today, then the likelihood is we're probably going to see a little bit more downside potentially into the closure tonight. And of course, given that there's no fundamentals or no bearish sentiments over the weekend, which obviously wait and see, we could see that gap closing oil back to 92.50. It's only still a guess as yet, but let's just see how this narrative plays out in the media. Other than that, that's pretty much it for this morning, guys. Okay, as well, one final thing. At the Alpha Capital Group, we are giving 30% discounts away for the funded challenge program. So if you fancy the opportunity of potentially trading a kind of a 50, 100 or 200 grand trading account, then you can get discounts off funded challenge programs and to become a sponsored trader with us. We are actively looking for profitable and successful traders. So if you feel you are one and you have a proven track record, there is also instant funding options available as well. All right. Until Monday, have a great weekend, everyone, and we will see you all next week.